Belated happy Thanksgiving to everyone and happy Black Friday. I did some early morning shopping this morning and I got a few discounts. So I hope you guys are doing some of the same. Let me have a quick check at the chat box so make sure I can see all you questions. There we go. All right. You guys can all hear me okay. That's perfect. All right, perfect. You know what? Let's just get started. I'm just going to start off with a couple things. Obviously, we've had some volatility here over the past 12 hours or so. I was looking at the screen and kind of trying to make sense of some things. And to us, the underlying, the overarching thing is that really not a lot has changed, to be honest with you, until we get some more information. But we're going to talk about that right now. But at the same time, what I really want to do is, first of all, actually share my screen, which I think I'm doing right now. There you go. And let's see here. Okay, let me just check one more time on the microphone. You guys can hear me, right? I see some people saying, or at least one guy saying no. Okay, sounds like we're good.
I hear you. Do you think tapping on the mic makes it work? Is that what you're doing over there?
I'm tapping just because I'm nervous.
I'm just jacking with you.
I've had like 9 cups of coffee.
I hear you. I hear your sweet voice. That's funny. And I do see your screen, and Silas and I have your back. If we can't hear you or see you, you'll get a WhatsApp from me, okay?
It's taken me 3 months to set up this damn microphone. I'm nervous that it's not going to work,
Lord, well, I can promise you the tapping on it's not going to help things. That's like keyboard.
Thanks for calling me out on that. That's awesome.
You're welcome. And I'll try not to mute this time. I tried to mute myself and I muted both of us, so that worked out.
Thank you. I appreciate it. Okay. So anyway, as I was saying, we're going to look at a new market opportunity, but we need to build a little bit of perspective before we do all that. And so what I'd like to do is just kind of go through a couple of things. This is me setting up my desk.
I gotta stop you though, because now we have enough people saying they can't see the screen that I need you to turn your, I need you to refresh. Just turn your screen share off and give it a second.
Okay.
All right, can everybody see the screen now? We're just over here in Techie Gremlin land. That's what we're doing this morning. We're excited about it. Okay, looks like you're live, baby, live. Go ahead.
See it now? Okay, cool. Yeah. Perfect. Yes, so this is me sitting at my desk right now when I'm not tapping the microphone. I originally have more of an investment banking background and moved on to the portfolio management side of things. I am the head trader and chief investment strategist at TheSteadyTrader.com. And what we're here to talk about is kind of what's happening in the market right now, to be honest. It's actually perfect timing. And this, of course, wasn't on purpose. I couldn't imagine the market would do what it does here today in the very near term, but again, we'll talk about that. So, okay, how am I going to profit from this new market opportunity? That is what we're going to look at. We're going to build some perspective, then we're going to go right into it. And then what I want to show you is a tool that we are using and I'd like to give you access to navigate how I think the markets are going to behave, not only for the remainder of the year, but then much more importantly for the next probably at least 5 years going forward. First question people have on top of their minds, whether that's this morning or any morning usually, is, hey, what's the S&P 500 going to do? And so here's what I'm thinking. If you look at the S&P right now, and let's just forget today's movement for just 1 second, we'll talk about that in a bit. I still think we could probably reach 4,800 this year. I know that doesn't sound like it this morning, doesn't feel like it this morning. Every inkling in our body this morning says that's not going to happen. I'm going to lay out the case why I think that could still happen. And we'll talk about that here in just a second. So basically, the way we look at it is that the trend remains our friend here in Q4. There's a lot of reasons for that. I'll lay out a couple of them, and I think these are kind of the most important ones. So a very simple sort of single factor model will look at something like seasonality through the lens of the S&P 500. And you can go much more complex in seasonality, but this is one way of looking at it. And so what I'm seeing here is a sort of 30-year, 20-year look back on the S&P seasonality, and what you can see is kind of what it does month by month on average. And we've had an almost to the tick perfect correlation on the 20-year look back model this year. Well, we're now in the fourth quarter, which is what I framed here in red, and we're actually right here where my cursor is, if you can see that, at the end of November. Of course, this morning, it doesn't look anything like that. It looks like we're like down here. But we have a few things that I think are going to continue to work for us. One thing is, again, aside from the seasonality, is basically what I call portfolio manager anxiety, performance anxiety. And that's not meant to be a sexual term. That just really means basically a lot of people are underperforming their benchmark, and they have to kind of chase the tape in order to make up and kind of justify their job for next year. That's a real thing, and that tends to happen at the end of the year. It's kind of a usual thing. The other thing you have going is essentially stock buyback programs. There was a massive amount of stock buyback programs that were approved by corporate boards, and they basically came into effect in the beginning of November, which is actually one of the reasons why we had such a quick sharp pop at the beginning of November. And we do think that's going to continue and potentially lift us through the end of the year. So those are just a couple of things that we see. So, you know, of course, in order for the market to go higher, you can't just say, well, the market goes higher. There has to be something taking place. And so what you want to do is you want to look at some sectors. And this is now an equity related question, but really as we look at this stuff, you'll see we're going to touch on different asset classes as well. And so what are our favorite sectors right now? It's some of the stuff that has been working. So one thing that we think will continue to work is financials. You can look at that through a simple ETF like the XLF. And the reason why this is in our opinion continue to work. And again, if you don't look at the tape just this morning right now, but if you look at it through sort of at least a multi-week duration, what you'll find is that interest rates at the margin are continuing to go higher, and we do think that is going to take place. So that is kind of where we are right now, and we do think that the financials are going to continue to like that environment. So whether one buys something like the XLF ETF or you know, a financial related stock like a Bank of America, that's not a recommendation, I'm just saying as an example. You know, those kinds of things in our opinion should continue to work here, at least for the fourth quarter, and we'll see as you get into the first Q1 of 2022 what that kind of looks like. So financials is one thing that we like, and again, this is not just because we like stocks it's really it's an interest rate function. So this is a cross asset analysis, and you know, every asset class or every sector within the equity space has a specific thing that tends to make it move. For financials, it's a lot of times it's basically the rate of change and the slope of the yield curve. So financials, XLF is one thing. The other thing is also financials. Actually, this is more of the same of what I just mentioned. It's just a different ETF, and this thing tracks insurance stocks. It's IAK is the ticker symbol. IAK is the ticker symbol, and we do think that has more upside as well. How about something totally different and unrelated? And that's the energy sector, XLE. Now, we could talk about the energy sector for about 2 hours right now, going into great details of why we think this is something that'll likely show good relative and absolute performance, probably for multiple years to come. But if you look at it more near term, and again, I understand oil this morning is down about 6.5%. So clearly this isn't going to feel like it, but I'll talk about this morning's move here in just a second as we go through the next couple of slides. Nevertheless, the XLE is such a small part of the S&P 500 anymore. It used to be like 10% of the S&P. The energy sector is down to like a 3-4% overall of the S&P, and we do think with all the environmentally friendly type of investing movement and all the stuff going on, we do think this is a part of the market that is likely going to do well. But what's even more compelling than just the absolute chart of something simple like the XLE ETF is really what it looks like in relative terms. And what we do here is we take something like an ETF, in this case the XLE, and I divided it by the S&P 500, so the SPY ETF. And what you get here is a ratio chart, a relative chart, and it shows you the relative movement. In this case, it's relative strength. If you look at the past, like almost 12 months, I guess, or something like that. And you could kind of call this, if you're the kind of person that likes to call patterns in a chart and draw lines, then you might imagine this to be something like an inverse head and shoulders pattern, which is actually a bullish formation. So those are a couple things that we like. I'm going to go out on a limb in terms of a different asset class, and we actually do still like the blockchain and crypto space. Broadly speaking, again, this has a lot more volatility, so this can't be compared in the same bucket as an equity. But from what we see from money flows and from institutional investors, among other things, this still should be something that should remain bullish into Q1 of next year. But let's talk a little bit about what's going on here this morning. And I don't actually have a chart on this, so I'm just going to quickly talk about it for a second. Let me go back to the S&P. So basically, if you look at this morning's movement, it's largely based on, again, the news coming out of the, I forget what the entity was that released the news, but of course around the South African variant. Of course, it's a classic risk-off move day. In fact, I can show you this. This is sort of one way I track. If you kind of look at this, I know it's a bit small, but it doesn't really matter. But you can see it's a pretty classic risk-off morning. You've got equities down. You've got risk correlated things such as oil and even Bitcoin down. You've got treasury bonds higher, yields lower. And so that's interesting. Now, it hasn't really changed anything fundamentally. Of course, if this variant were to be crazy potent, or whatever the technical term is, and be much, much worse than anything we've seen, then I would argue this could ultimately change things. Right now, to me, this is a function this morning of a bit of market dislocation. Essentially, it's a very thin market. Obviously, U.S. markets are closed yesterday. Global markets adjustedly lower trading volume because of that. And so it's very simple for algorithms to push markets lower this morning or overnight. I personally think this is a buying opportunity. It's not a recommendation. That's just our house view for the remainder of the year. Now, again, the news out of left field could be that this is something crazy and it changes the whole game about, vaccines and everything. I don't know. I can't make that call. I don't want to make that call. But I think outside of that, just looking at what's from a market structural perspective, the past 24, 48 hours have really come in a lot less volume. So it's much easier for algorithms to play this game of pushing the market lower. And if I were to play devil's advocate, knowing how hedge funds work, I wouldn't be surprised if some of the London desks of New York-based hedge funds that were open yesterday and overnight, where they have the Asian desks, were probably trying to push these things lower so they can buy them again lower, basically now or the next few days. So that's kind of how we're looking at it, because from a structural perspective, we haven't really seen much change. So that's kind of what we're seeing right now. Again, this is not to say that this can't go a bit lower. Again, it's a very thin half-day trading session today, but that's kind of what we see. So we want to continue to stick to our playbook here of being long the things we said: financials, energy, and even if one's risk parameter allows it, something like the growthier parts, or maybe more established parts of the crypto and blockchain universe. So that's what's going on there. But I think the bigger opportunity, and this is what I want to get to as I show you the tool that we use and we want to give you access to as well, is we think 2022, so we're talking about a few weeks from now, is going to usher in a dynamic and opportunities for the markets for the next 5 to 10 years. And it has to do with the I words. And this morning, the dork that I am, I spent about an hour and a half reading through a major.
Hey guys, I'm stepping in here trying to get a hold of Serge. I'm gonna message Serge right now and let him know that we lost sound.
Hey Sal, does this sound better?
Yes, you're back.
Weird. Okay, I don't know why this is weird. I've never had this happen before.
All right, you're good.
All right, cool. Thank you. Sorry about that, guys. Anyway, so what I was talking about here was the inflation word, and essentially for a lot of people, this is kind of the first time in their life they're using this terminology. They don't really know exactly what it is, but it is a little bit scary when you see things like that. Natural gas, which actually this morning is up another 4.5%, and for what it's worth, I do think it's going to continue bullish. But it's an interesting dynamic of what's happening, and of course the big debate is whether it's transitory or not, right? So that's kind of the big issue. You can see it in anything from commodities to of course interest rates. And one of the things that's scary about this for some people is what it means ultimately for pass through to the consumer, and then of course consumer spending were to slow. And we're already seeing that the propensity to spend this Christmas season is actually a lot lower than it tends to be, as the latest statistic I came across from this morning. And even worse than that, what you're likely going to see is for the Fed to basically start raising rates quicker than people think, and kind of double down on things, and that's not really a good thing. And that could be one of the big issues that we see going forward. So the question, of course, is, what does that mean for personal spending? We've already seen personal spending and savings peak, actually. So we think it's kind of a big structural shift that could last for 5 to 10 years. That's literally about to happen as we post-pandemic. And I know the using the word post-pandemic this morning doesn't seem appropriate given the news we just had. Either way, in any way, the new market opportunity is that we expect a lot more volatility going forward, but also that means for people who just buy the S&P, it's going to mean much lower stock market returns. So there's something we need to do. And just to give you a simple visual of the S&P, this is what it looks like. And by the way, this is just the past decade, this movement here. So that's a really, really big and crazy move. And our base case is that we're going to see more of a sideways movement, not a crash necessarily, but sideways movements for maybe 5 to 10 years. And that's enough for a lot of people to get into trouble. So we think there's a simple yet crucial adjustment that should be made to pretty much most people's strategies, because most people are very directionally exposed when it comes to their strategies. And so we want to make sure that one can still navigate the markets very nicely, but there's a simple adjustment that we strongly believe should be made as we get into a market environment that is going to be much less linear than we've seen for the past 12 years. A lot of people have gotten used to, the S&P returning 14, 15% a year, and that basically being a direct correlation to their portfolio and lifting it. If that stops happening, and I'm not talking about market crash, I'm talking about market going sideways, that's enough for most people, whether you're working part-time, full-time, retired, soon to be retired. That's going to be a big problem for most portfolios. So we want to make sure we don't fall into that trap. So I have a question for you guys, and I promise you this is going to be one of the few questions because I don't want to turn this into a big questionnaire. But the question I have for you guys, type in a quick yes into the chat box if it is one of your goals to have a steadier stream of positive returns in your portfolio, meaning monthly positive returns or quarterly. Type in a quick yes. This is an important exercise we're going to do for you to yourself admit to yourself that is one of your goals. Most people actually are not aware that that's one of their goals. So type in a quick yes if that is one of your goals. And some people are saying yes, of course, or yes for sure. That's actually not that obvious because we know a lot of people are not consciously aware that that is one of their goals. Now, given the fact that that is most people's goals, as is being verified again by you guys being so nice and participating in this exercise, what we know is that because your portfolio is so highly correlated to, let's say, the S&P 500, when the S&P stops going higher, you're going to have a problem. And so most strategies are basically very closely linked to global risk on, risk off, which for our intents and purposes, the S&P serves a great measurement of that. So basically, when you look at the S&P 500 on sort of a random month-over-month performance, it looks a little bit like this, right? You have big up months and big down months and everything in between. So there's really no real correlation of being able to give you a positive return on any given quarter or month in a row, right? And so that's an important thing to understand. Does that make sense? Right. So if one of your goals is to have a steady stream of positive returns, monthly or quarterly, whatever, quarterly being a bit more reasonable, then this is an important thing to be understanding, right? Because if and how many have noticed that when the market is down, like the S&P is down for a month or two, that your portfolio also doesn't do very well? How many people notice that? And that's what I'm talking about. So something has to change, and that's even more important when we go into an environment where we think the market's going to basically stop going higher. We're thinking to cut right to the chase that the S&P is going to make between 2 to 5% per year for the next 5 to 10 years. That is a galaxy away from what we just have for the past 10 to 12 years. That's a very different environment, right? And so I want you guys to understand that. Of course, I can't guarantee that's going to happen, but it's our absolute base case. And again, just to kind of give you the previous page, I hate to go back and forth, but just quickly want to go back to this. This is what we've seen for the past decade. It is highly unlikely that this rate of change will continue. That's really the only point I'm trying to make, and that is enough for most people, particularly if they're trying to rely on their portfolio, whether they're going to be retired or soon to be retired or part-time, full-time working, whatever. If there's any reliance on their portfolio, something has to be, a small change has to be made. And I'm going to walk you guys through that right now. So basically for most people, their sort of profit and loss curve looks like this mountain range right now. So they make a bunch of good trades, and then they have like one or two bad ones, and they have to start right back from the beginning, right? And they continue doing the same thing, and they have a nice upward sloping P&L curve, and then they have one or two bad trades, and they continue to repeat that. And so the issue with that is not only it's a financial problem because of course you're not making money. Really the bigger problem is psychological, because you start getting yourself into a position where you get frustrated, and before you know it, you're basically just gambling, right? So what I want to talk about here is that whether it doesn't really matter whether you have a stagnating or a losing account, it is for the most people going to start sort of eroding or chipping away at your confidence, not only at your personal confidence, but of course also that in your strategy. And then that leads down a real sort of rabbit hole where you start basically gambling, and then it's kind of game over, right? So what I want to show you guys right now is I want to show you how you can use a very repeatable strategy, and I will use our tool here to demonstrate this that we can give you access to as well here in a bit. And it's something that I think is just unbelievably important to start using as we start getting into this new market environment. And it works just as fine in any market environment, but I think it'll be even more important to start using this going forward, like basically starting now. Doesn't take a lot of time. You can see about an hour a week, and it's verified to have about between 8 and 9 out of 10 trades are profitable. So let's walk through why and what. First of all, it has to do with steep slopes. So you can have a steep move that goes vertical. I'm sure you guys have all seen these kind of slopes before. Steep move goes vertical, and at some point the move becomes so extreme that it just can't continue for a while. Same thing can happen on the downside. You get what's called downside exhaustion, right? So you have a steep move followed by a vertical drop, and then it just gets so oversold that it'll stop going lower for a while. So that's what we're looking at here. So a couple things happen when a steep slope goes vertical, then the implied volatility or the price of options becomes a little bit elevated. I'll talk about that in a minute. But more importantly, the investor fear or greed reaches extremes. And so what that allows us to do is put on basically a simple mean reversion move trade. And it's one of the highest probability things that I know to do. And this becomes even more important to do, again, when the markets become, as I said, for the next 5 to 10 years, very different than they have been for the past decade. So let's talk about this a little bit. How many people have ever used options before in here? Give us a quick yes if you have, or maybe you know if you haven't. It totally doesn't matter whether you have or have not, right? And so the reason I'm asking is just because of the following. So there are some statistics out there around options that people will try to tell you. And I'm going to quickly just demystify these because I think it's always very dangerous to believe in these statistics. So people will tell you that the odds are strongly in favor of people who sell options. Maybe some of you guys have heard that before. The reason they tell you that is because the statistics are that if you were to buy an option, let's say a call or a put, and you were to hold it through expiration, the odds are only about 25% that you'll make money, meaning the odds are 75% chance that you will lose money if you were to buy a call or a put and hold it through expiration. So what people will try to tell you is like, hey, instead of just buying the option, just sell it, like sell it to open as opposed to buying it to open. Just do the reverse. That'll should give you the stats of having a 75% chance of making money. And of course, nothing could be further from the truth, because unless this is done right, and what we're seeing out there is that most people are not doing this right, this is a very, very risky thing to do. Maybe some of you people have used weekly options to do something like this, where they try to tell you to have a theta play strategy, time decay strategy. Well, over time, I can tell you this is one of the most riskiest things you can do. As one of my former jobs as a fund of hedge fund analyst, we used to analyze strategies that do just that, selling short dated options, and over time, 9 out of those 10 funds ended up blowing up, right? So that's not something you want to do. So let me show you what we do. So here are the only very simple 4 steps we're going to do. We're going to look for those steep slopes that go vertical that I just showed you here in a minute ago. We will make sure that implied volatility is a bit elevated. Just basically means that the options prices we're looking for are a little bit more expensive. That's something very simple. But more importantly, even than that, is that the liquidity is there. So we want to make sure we use very liquid options, meaning lots of volume basically. And then step number 4 is important, but I want to quickly, before I even talk about this, I want to mention something important. We do this in a very specific way. So even if some of you say, oh, I've done this before, I mean, the odds are quite low. The odds are almost
maybe 2% only that you've done exactly what we're about to show you, because we can see what's being done on the retail side and even on the institutional side. This is simply not being done because it's the opposite of what most people do. So in simple terms, and we'll show you this right now, we use what's called far out of the money call or put spreads, and we use those options that expire 2 or more months out. But there's a huge detail to this, actually 2 details that I'm going to reveal with you right now, and that is the key. Without those 2 details, this won't work. And then we rinse and repeat this on a monthly or quarterly basis to really generate and build us that income. Does that sound good? Okay. So again, we're looking for very steep slopes, such as these, that go vertical, right? And you can see after the vertical move, upon the steep move, the asset in question will tend to stall for a period of time, right? You can see it here too in Netflix. Crazy moves to the upside, beautiful moves. But at some point, it gets so exhausted that it simply can't continue for a while. And that's our opportunity set right there. So again, when slopes go from vertical to steep, or from steep to vertical, then the upside becomes capped, or if that moves to the downside, then the downside becomes limited. In other words, the asset will tend to stall in price. The asset will tend to stall in price. And that's really what we're looking at here as being the most important thing that is going to be the driver of the returns that we're looking for. So let's have a look at this. We're going to look at Facebook here right now together, and I am going to walk you through this in terms of an actual chart that I'm going to bring up on the screen. But what you can see here on Facebook is that the stock had this steep move to the upside, and then every once in a while it had the vertical move, right? Here and here and here. You guys can see that, right? And each time we had the vertical move, the asset then ultimately ended up stalling, right? Yes, it ended up mean reverting down. You guys can see that as well. But more importantly, it began to stall, right? It didn't go higher for a while. And that's really where the opportunity is. So what I'm going to do is I'm going to take my chart and I'm going to actually bring it over here so I can draw on it and so you guys can see this very clearly. So this is the same chart that I showed you just a second ago on the previous screen. And you can see again, Facebook moving up higher here in that steep orderly move. And we'll focus on this point in time here, where you can see Facebook has once again reached the upper end of that trend. And so when we get to a point like that, where the stock gets to the upper end of its trend, what are some of the things we could do? Does anyone have any idea? What could you do if the stock gets up here? If you owned it, let's say, maybe you owned the stock, right? If you own the stock, you could maybe take some profits, sell some of it. I think you guys would probably agree to that would be something one could do. Well, you could also maybe, if you were a bit more bearish, you could maybe short the stock, or maybe you could even buy a put, right? If you think the stock's going to stop going higher, maybe even go lower, maybe you could buy a put, right? You guys see that? Now, of course, if you buy a put or you short the stock, there's only one way in which you'll make money, and that is if the stock goes down, right? So let me repeat that. If you're going to buy a put here, or you short the stock, unless the stock goes lower, you're not going to make money. In fact, you're probably going to lose money. But does the stock have to go lower at that point? Is that the only thing it can do? I wish, right? But no, of course, it can also go sideways and go higher, right? The stock can do one of 3 things. It can go down, sideways, or lower. But if you buy a put or you short the stock and you only can make money if it goes down, what are your odds of making money, all else being equal? Anyone have any guesses? That's right, it's 33.3%. So if you are in the business of giving yourself a high probability of making money and you're making a directional call, a directional movement, in this case, you're only going to make money if it goes down, you only have a 33.3% chance of making money. Does that make sense, everyone? Right? And since a lot of you, in fact, probably all of you before, most of you said that you have it as one of your goals to want a steadier stream of positive returns, it doesn't make sense to give yourself only a 1/3 chance of making money, all else being equal. So how can we make money in a situation like this, whether the stock goes down, sideways, or even against us to a pretty good degree? Well, let me show you how this works. So instead of making a directional bet, we simply made, in this specific instance, we made a bet that the stock isn't going to go more than another 8% against us. So what we did is something very simple. We used a call option here, and we sold it. This is what it looks like. And then we bought against that another call, $5 higher. This one trade you do, this is one order, one trade. It's very straightforward. And basically, this structure allows us to make money whether the stock goes down in this case, sideways, or even if you were totally wrong and the stock were to go 8% against you, you can still make money. How many of you guys like that idea? Give me a quick yes. There's two really important keys to this, why this works, and I'm going to uncover those here and reveal those in just a second. So how many people would be okay putting on trades where you no longer have to be directionally dead on correct, where you no longer have to be dead on correct in terms of timing, and where you no longer have to be dead on correct in terms of the magnitude of the move? If you buy a put here or you short the stock needs to go down. It needs to go down now, basically, and it needs to go down by quite a lot for you to make money. But what if you could desensitize your trade? So what we do very specifically in this specific instance, what we did is we sold, and I'm just giving you a historical example so we can go into the live market, and we sold a call here and we bought a call against it, right? And we received actually $1, which means $100 deposit in our broker account up front. If you would have done this with 10 options contracts, you would have received $1,000 deposited up front, right? This is really important. Now the spread very quickly was reduced down to 24 cents because the stock went down, which basically means we made 76, we got to keep 76 cents of the initial $1 we received. So we made $760 per 10 options contracts, or $76 per contract. But the crazy thing is the stock didn't have to go down. It could have just as well gone sideways or even against us, technically up to 8, so whatever we said, I think 8%, right? How crazy is that? How many people like that? Now, let me give you two really, really important things, and this is really crazy important, so let's talk about this. Number one, you might notice that at the time we put this trade on, it was February, but you might notice that we didn't use February options. We didn't even use March options, we used April options. Why? And this is, I can't tell you how important this is. Although if you don't do this, this won't work. So let's assume we would have used short-dated options. At the time in February, that would have meant let's using, say, February options. If the stock would have then moved, let's say, 5% against us, we would have very quickly lost like 3 wheels on our car, right? You toast because you're using short-dated options. But what if you used in February April options and the stock moves 5% against you? In that case, maybe you get a flat tire, right? So instead of losing 3 wheels, you get a flat tire. And I can't tell you how important this is. But the other thing that's crazy important about this is the fact that we only hold these trades on average for about 2 weeks. Let me repeat this. We use options expiring between 45 and 75 days out, but we only hold these trades on average for about 2 weeks. That is the key of why this works so well. Are you guys with me so far? Let me show you guys a couple more examples here. Like we can go into Tesla just to give you an idea, because I know everyone knows this name. The stock got very oversold. We didn't feel comfortable buying it, but we thought it'd be worth putting on this trade. So we sold what's called a bull put spread. It's the same idea as the previous trade, just using puts. We received $225 in our account, or $2,250, and we were able to keep $182, meaning we made a profit of $1,820 in just what, like I think 2 weeks or so, or 3 weeks. And you can see the stock went higher, but it could have just as well gone sideways or even down. Let's look at another example. Let me show you another one. This is the S&P 500, the SPY ETF. This was at the lows of the market last year in March of 2020. And you can see that the S&P had dropped like 19% or something. 29% in like 3 weeks. And so we didn't feel comfortable buying the S&P, but we said, you know what, it might be okay to make the following bet. And so the only bet that we made is that after a 30% drop in 3 weeks, we said it wouldn't go down here, which is 18% lower. So in March, we used June options, right? And you can see on the day we opened the trade, which was March 16th, on the day we closed it, March 24th, the S&P was at the same exact level. Yet we made 11.4%. How many people would like to put on trades where you can make 11.4% in a matter of what is that, a week or 9 days? and the index didn't actually do anything, or the stock didn't do anything, right? How cool would that be? That's really important. So let me just go right into and show you how we actually find these things. Because what's really important about these trades is that we're doing these trades to kind of build sort of a layer or base of income. And it's the first thing we do every month and quarter and week is put on these kinds of trades. And this is I think a vital way of looking at the market for the next 5 to 10 years, as we have to desensitize our trade. So how do we find these things? Well, look at these blue arrows. These blue arrows tell us whether a stock or an index or whatever is short-term overbought or oversold, in this case, overbought. You can see to the right of that last blue arrow how the stock stopped going higher, right? And we're only concerned about the 1 to 2 week time frame. And you can see it stopped going higher. In fact, it went down. That's our opportunity set right there. How about here in Alphabet? Look at to the right of the last blue arrow. What happened to the right of the last blue arrow? The stock stopped going higher for 1 to 2 weeks. That's all we're asking for. We're not asking for the stock to go down, just not a lot higher. How about in this ETF here, XLY? What happened to the right of the blue arrow? It stopped going higher, right? You guys can see that, correct? Okay, give me some ticker symbols, folks, and we're going to go into the market right now. The market is open right now, obviously. So let's have a look at the market. And if you guys want to type in some ticker symbols, we'll go ahead and show you right now what this looks like so you guys can kind of get your head around this. The first one here comes from Jeff, and he wants to look at LYV. I'm going to quickly type that in. And by the way, just so you guys know, I have a different screen resolution on my other screen. So that's why I have to keep going back and forth here. But this is LYV for Steve. Steve, can you see that little blue arrow at the top here? You see how that the stock market or the indicator told us that the stock is overbought? Well, since then, this stock is now down 17%. The indicator doesn't tell you that you have to short the stock. It's just telling you that the stock is very unlikely to continue going higher for the next 1 to 2 weeks. So what do? We sell a call up here. We buy a protective call a bit higher, and we move on. We hold it for 1 to 2 weeks and we move on. Does that make sense? Do you see that, Steve? Right, so this stock is down 17%, so you would have already made really nice money by like a few days ago, right? But again, it doesn't matter whether the stock goes down, sideways, or even against it to a degree. And when in about the 10% of cases where the stock will continue to go against you, you're going to lose very little money because of the way we structure the trade. Steve loves it. Okay, great. Perfect. Okay, give us some more. What other tickers do you guys want to look at? Perfect. Okay, so this is Moderna. Mont, M-O-N-T, is asking for Moderna. Okay, Moderna is right here. So Mont, the last time the indicator told us that it's overbought was there. And you can see what happened for the next 1 to 2 weeks to that stock. It stopped going higher. In fact, it corrected 25%. You see that, Mont? So what do? You sell a call up here, you buy a protective call against it, keep it on 1 to 2 weeks and move on. Mont, does that make sense? So, but again, the stock doesn't have to go down for you to make money. It could have just as well gone sideways or even higher to a degree, right? Could have gone at least probably 5-6% against you. Does that make sense? So the reason why that's not true, Carl, is because of the way we structure the trade. If you structure your trades differently, and that's true. Carl is saying the problem is if a trade goes against you, you lose a lot of money. No, you won't. First of all, we don't hold anything through earnings. And number two, we use options expiring 45 to 75 days out, and we only hold the trades for 1 to 2 weeks. That's the key, okay? That's really important, but none of this is as important as ultimately finding where you can put on the trade. That's why we developed a little bit of a tool. Actually, it's an awesome tool that will show us where to put on the trade. Verizon, okay, this is a bullish example. All right, so look at Verizon. If you look at Verizon, you can see it told us the stock was oversold on the 12th of October. And you can see over the subsequent few days, the stock ended up rallying 5-6%. So if you would have sold a put, bought a put against you here, received the credit, kept the trade on for 1 or 2 weeks, you would have made nice money, right? The stock stopped going lower. That's the only thing we're asking you for the next 1 or 2 weeks, and it worked out perfectly. You see that? I think Lisa was asking that question, or Lenny, sorry. A lot of L's. Okay, that's Macy's, right? Okay, so this is for Ronnie. Wants to look at Macy's. Macy's had an overbought signal as per the indicator right here. You see that blue arrow? And so you can see that over the next few days, Macy's dropped 18%. So what do we do? Well, once the arrow stops printing, which is on the 19th of November, or was, and I think we sell a call, we buy a protective call against it, keep the trade on 1-2 weeks and move on. Do you see that? That's all we do. Another retailer, BJ, Christoph, BJ. Okay, so let's look at the last 2 examples since this is a longer chart that just came up, right? So I just typed in BJ, that's all I did. So you can see the last time back there, indicator told us the stock is overbought. It then ended up dropping 21%. How about just recently here? It just told us the stock is overbought a few days ago. It's down 4.5% since. So all you do is you sell a call up here, buy a protective call against it up here. You keep it on 1-2 weeks and move on. Are you guys starting to see this? And by the way, is anyone a day trader in here? Let us know if anyone's a day trader. Yeah. Under Armour, sure, that's another one. Okay. Here's Under Armour. Okay. Look at Under Armour. It told us the stock is overbought on the 4th of November, so a few weeks ago. The stock then stopped going higher, right? It's now down 9% since. And all you would have done is sold a call, buy a protective call against it higher, keep it on 1-2 weeks and move on. Again, we're not asking for the stock to drop. It doesn't have to drop. It can go sideways or even against you to a degree and you can still make money. You guys see that? Yeah? Okay, let me show you a couple of intraday examples. I want to make sure we keep on track here. So some people want to look at intraday. So let's have a look at intraday. I'll use like a 5-minute chart, for example, right? So let's just stay with the stock that we have right now. So we were just on Under Armour. You can see oversold overnight, and then the stock ended up rallying 3.7%. You guys see that? Yeah? Who can see that? Does that make sense? Yeah? Okay. Or silver. Okay, here's silver. I know these are some wild names or silvers. This was overnight tonight, just a few hours ago. Oversold, and then it ended up rallying 1.3%. You see that? Yeah, if you do it intraday, you can just buy a put or a call. You wouldn't want to do credit spreads intraday, right? Any other tickers you guys want to look at intraday? What else you want to look at intraday? Anything? Apple, sure. Okay, here's Apple. I don't think it has anything yet today, but this is like a couple days ago. Look how it was overbought, and once it's overbought, once the last of the blue arrows prints, you can see then Apple ended up selling off for the rest of the day, down 2.5%. Right? You see that? Perfect. So as you guys can start to see, this is a process that really works, right? Who can see that this works, and who thinks this would be something that would dramatically reduce, the craziness of your portfolio? Can you guys start to see that? Yeah. Okay. Maybe one more. Let's show you guys one more. Some people are asking. There's a lot of tickers. Okay. Let's give you maybe one more. Let's see here. Maybe. I'm gonna make sure it's a ticker you guys everyone knows. Intuit. Okay. Intuit. Here's Intuit, INTU. So this told us it was overbought on the 19th of November, and it's now down just 5%, but we're not asking for it to drop. It just needs to stop going higher at the rate. So that would have been really nice. You guys start to see this? Who likes this? Perfect. Well, look, as you guys can see, this is a process that works. So what I want to do is I want to introduce you to the options income secrets, because that's why you're here today. That's why you want this steady stream of positive returns. And so we know that a lot of people want that regular stream of positive returns, whether that's on a quarterly or monthly basis. And so we want to show you exactly how you can do this as well. So what I like to introduce you to the options income secrets package here today on this Black Friday. What you're going to get is our monthly options income strategy that I've shown you here today. That's going to help you produce a much steadier stream of positive returns over and over again, because you're desensitizing your portfolio, right? And so with this package, you're going to be able to know that every month you have a reliable strategy. You really put the odds in your favor and dollars in your account. And with the package, you're going to learn how to use the options the way we do. The benefit is that you start trading with confidence, you start trading with a process, and it gets a bit easier every day until it becomes second nature. I'm going to give you a cheat sheet as well, so you're not alone. We know that trading is all about having a process, and I really can't emphasize that enough. So when you follow a cheat sheet, it's exactly there just for that. So, and I also want to give you an edge in the market, which is why we're going to give you the indicator that I just showed you here today and the scanner, we're going to give that to you as well. It's all about having an edge in the market, and the reason winning traders win like they do is not just based on knowledge, right? That's really important. So everything you need, we're going to include here. One of the best things about this setup is that we are going to give you a way to look for these things right away. So I'm going to show you it for a second right now how you can scan for this stuff. So you can actually use the indicator on Thinkorswim, TradeStation, NinjaTrader, TradingView, Wealth Charts, and MetaStock. And it's super simple. You just scan for it, and then you click and you find the trade. So let me quickly show you, like for example, on Thinkorswim, that's the one I happen to have on my chart right now. So let's just look at, for example, we have two scans, overbought and oversold. And let's just look at JWN, right? This is Nordstrom. I just clicked it with one button right there. You can see it's now getting oversold. You can see that little red arrow. You can see last time it was overbought was back here in March. And you can see how the stock then ended up dropping 25%. And we're thinking it's probably going to bounce again here now, right? Can you guys see that? Does that make sense? So it's super simple to use, and you can install it on Thinkorswim, TradeStation, NinjaTrader, TradingView.com, Wealth Charts, and MetaStock. So we've got the whole suite there for you. And so the best thing, what makes the Vertical X Pro indicator so awesome is that it gives you access to the highest probability credit spread trading setups and even day trades. I'm going to give you a platform, a foundation that whether you're new to trading or you've been trading for a while now, that you have this strategy and you have this tool that you can rely on month over month and quarter over quarter just to create a steadier stream of positive returns potential, right? And that's exactly what this is for. You guys start to see this? Who likes this? So we're going to give you everything you need to put you on the right path here. We're going to give you a video course. We're going to give you a cheat sheet, the indicator, the scanner, and we're even going to give you lifetime, monthly, twice monthly member webinars where we even give you a trade in each one, right? So that's really, really powerful. Quickly though, you can see some people what they're saying. Dave, he just wrote to us the other day. He said, Serge, if you follow the rules that Serge lays out, you can make good, steady income. Some of the other people, Jim, great indicator, great strategy. It's my bread and butter strategy. What's important is that you follow the rules. The rules we have are there for a reason. They're very simple, but they are important. They're there for a reason. So if you're more of the kind of person who's in the markets for swinging for the fences for entertainment, this is probably not your thing. But if you're serious about it, right? If you really actually want to make money and you can see that the next 10 years are going to be probably different than the last 10 years, the S&P is not going to make 15% a year, this is something really important, right? So let's go right into exactly everything you're going to get. If you were to add everything up together here, the course itself, that's $199. The scanner, the scanning sessions we do twice a month, every month for life is $500. The indicator is almost $2,000. We have an Iron Condors course included as well. The total package value of everything is $2,693. We are going to give you a crazy Black Friday discount here of 90% off. It's only $297. Now, that $297 is not a recurring fee. All this is a one-time payment for life and your lifetime member. You can also, by the way, use PayPal for this if you like. I'm going to quickly type this in. It's www.steadytradersecrets.com/secret. It's actually already been typed in. And here's how it works. So when you come on board, and you're one of the first 50 people, you will get access to all this stuff. Instead of paying $2,700, you're going to just pay $297 today on Black Friday. That's a crazy deal. It's 90% off, but it is limited to the first 50 people. Just like if you go into a store and they have a limited amount of things at a certain price, same thing here. Now, in addition to the indicator and the education material you get with it, to me, what's one of the most important things is our twice monthly live webinars we do for members. In these sessions, we teach you exactly how the strategy works. We teach you exactly how to use the indicator very specifically. It's very simple, but it's important that you follow the rules because the rules are there for a reason. And thirdly, we're going to give you a trade every single time in each webinar. So the next one's November 29th, which is this coming Monday in a few days. And it's going to happen at 11 a.m. Eastern, 8 a.m. Pacific. And these are live sessions. We will send you the recording with about an hour or so of the live session. And if you want to attend live, that's great. If you don't want to attend live, don't worry, we'll send you the recording. And this happens, for the life of the product. So we do these twice a month. And if all you want is a trade once or twice a month, would it be worth you to pay $297? right? And this is one of those situations where it's not about making the right or wrong decision, it's about making a decision. You guys can see how this works, you can see why it works, and you can see that if the markets start becoming a bit more jittery and stop going up every single day or month or week or year, you're going to need to desensitize your trade. And you give me your ticker symbols, I type them into the chart so you can see that it works. Yes, that includes a scanner, Robert. You can use the indicator on different market platforms, right? So let me quickly show you what that looks like. So once you start logging in and you signed up for it, you're going to get to the product page, and then you'll be able to, with one click, get to the page of where you can install the scanner or the indicator. So you can use it on Thinkorswim, Metastock, TradingView, TradeStation, Wealth Charts, and NinjaTrader. Each one of these is a bit different, so whichever platform you have, you know best, but you'll be able to scan for it, right? You'll be able to scan for it regardless which version you have or what your broker or charting platform is. And as I showed you here a second ago, it really just takes a second to find new trades, right? So it's www.steadytradersecrets.com/secret, and it's for the first 50 people. The next members webinar is this coming Monday, and I would urge everyone to attend live if you can. If you can't attend live, don't worry, we'll send you the recording shortly. How many people could see themselves using this indicator? How many people could see themselves trying to desensitize their trades by not having to be dead on correct in every single trade, by not having to be directionally correct, by not having to be timing-wise correct, by not having to be magnitude of the move correct? It's a complete game changer. Once you start thinking this way and you start using this strategy and this type of thinking, and ultimately, of course, the indicator, you will start to see that you will calm down, because just because the stock doesn't go in your direction right away doesn't mean you won't make money. In fact, you'll probably still make money, right? So all you have to do is go to www.steadytradersecrets.com/secret, be one of the first 50, and you will get full access to everything. The next member webinar, and it's live, is going to take place on November 29th. That's this coming Monday, just a few days from now, just after the weekend, 11 a.m. Eastern, 8 a.m. Pacific. We're going to teach you exactly how to use the indicator, how to use the strategy, and we give you a live trade each and every time. And if you can't join live, we'll send you the recording literally within an hour or two, right? And that happens twice a month. So the question you have to ask yourself is like, hey, listen, if you look back at this, let's say 3 or 6 months from now, and if all you did is were to say, hey, I was able to have a 30% return on a couple of trades together, would that be worth your time? Would that be worth $297 one-time payment? Yes, and yes. And would it be worth having something to find things, to find options trades or find trades in general, whether you day trade or swing trade, which is the credit spreads, that can just drop your blood pressure, where you don't have to be correct in terms of timing and directionality, right? Carl is using, so if you use interactive brokers, how would that work? If you use interactive brokers, you can use maybe tradingview.com. You will not be able to install the indicator on interactive brokers. You will have to use a different charting platform because interactive brokers does not allow us to install it there. Perfect. Steve is asking, will we get email to get? Yeah, exactly. So as soon as you're on board, as soon as you sign up, you should receive whatever within a very short period of time, maybe, I don't know, a couple hours or so after welcome email, you should start receiving emails of where to log in, probably much sooner than that, to be honest with you, where to log in, where to find everything. You get right to this page, you can install the indicator, and then be up and running. So you can use it, right? So let me go through it one more time, and then I'm going to pass it back to Jeanette. You will be able to use this indicator and scanner on Thinkorswim. Let me just quickly go back. Okay, you'll be able to use it on Thinkorswim, TradeStation, NinjaTrader, TradingView.com, Wealth Charts, and Metastock. Okay, does that sound good? Exactly. These are the ones you can use it on. If you have I don't know, like a Fidelity or something, you can just go to TradingView.com. It's a free website, and once you have the indicator from us, you can install it there. Does that make sense? I look forward to having you guys on board. Thank you guys for joining in here. We're coming up on, I think, we only have about 20, 18 slots left. And I'm going to pass it back to the guys in just a second. Let me see here. Do we still get the recording of today? Today, I don't know, but this is the next member webinars is going to be on Monday, right? Can you have both scanners up at the same time? Liliana, yes. I mean, that's a different, the vertical X is different than the other one, but yes, you can use both, depending on where you install it, of course. Yes, exactly. So thank you guys all for joining. Happy belated Thanksgiving, happy Black Friday. It's 90% off here on Black Friday. Take advantage of that. The slots will be taken up here probably very shortly, and they're going to be, and the price will go back up. So $297 for lifetime access for the indicator and the lifetime webinars, I think is one hell of a deal. And last question here by Steve, can I install the indicator on multiple platforms? Steve, absolutely yes, you can do that. Absolutely, you can definitely do that. StudySergeSecrets.com/secrets.